Let's talk about the impact of managing capital gains tax liability when considering the transfer of wealth from generation to generation. I'm Aaron Whalen of Opus Wealth Management. Have you ever actually sat down and calculated the entire embedded capital gain tax liability across all of your assets? Over 1/3 of the capital gain that you've appreciated over time will ultimately be paid in taxes unless you find ways to mitigate that. As a refresher, capital gain is simply the difference between what you paid for an asset and its value today. And typically, depending on the state, you can be paying up to 1/3 of that capital gains in taxes. Fortunately, there's some ways to mitigate that, particularly if you're considering an asset that you don't necessarily need to benefit from that's highly appreciated, because if you pass it on to your heirs, there's something called a step up in basis. And what that means, for example, is if you bought a home many years ago for $1 million and it's now worth $2 million, if you sold that today with $1 million gain, you'd be looking at over $300,000 potentially in capital gains taxes. But if you pass that asset on to your heirs, the cost basis steps up, meaning that the new cost basis is the same thing as the value. And if they then sell it after your passing, there's no capital gains tax liability at all. So really critical to think about your overall balance sheet, thinking about where you have embedded gains, assets you need to benefit from today, and those that it makes sense from a capital gains tax perspective to pass on to heirs before you actually sell them. Always a good idea with complex matters like this to consult with both your financial advisor as well as your CPA.